The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A cautious calm on Wall Street as the S&P reaches for another record high. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. It's nice to see you, Romaine.
Nice to see you too again.
Yeah.
Here in the daylight.
Yeah, here in the daylight. Let's take a look at where we're heading to when it comes to this close. As Romaine said, we're reaching for another record on the S&P 500. We just need to hold at roughly these levels. The S&P 500 up about 0.3%. What could be the stumbling block is what's going on in tech right now. You have the Nasdaq 100 down slightly on the day, just slightly, but we know we need those big names to cooperate here. You take a look at what's going on in the bond market. We had a pretty sizable 10-year yield auction at 1 p.m. That went over pretty smoothly. We had seen a big concession built into the long end coming in a little bit, but yields still about 1 basis point higher. And then the VIX, Romaine, we're having volatility drain out of this equity market. Your VIX currently trading with a 15 handle.
Volatility lower, at least the predictions of going back to the Nasdaq. That really is a big story here, the lack of participation by big tech. But I don't know if you can put the Dow Transports up on the screen because they are having a phenomenal day, outperforming the S&P by the most in 2 months, powered by the best day for airline stocks in 3 months. A bullish earnings call from Delta earlier today that included a reinstatement of an annual forecast, and that offered markets a hard but welcome lesson on how subdued investor expectations can lead to ecstatic share gains.
There's this adage that the market is climbing a wall of worries. And I always found this a little counterintuitive because the greater the worries, the lower the wall. And I think that's what we have seen so far this year.
And the gains today not confined to the airline and travel space. Nasdaq Biotech, which got walloped on Monday, now on a 3-day rebound above its 200-day moving average. Nvidia, once again, flirting with the $4 trillion close. And Bitcoin hitting a fresh record, lifting crypto stocks and DeFi stocks alike. Coinbase Hive strategy among some of the more notable gainers. But alas, every rally still met with a tinge of skepticism given the lingering issues on trade. Conagra, just this morning, forecast profit below expectations, citing rising costs from U.S. tariff policy, a policy that Trump is now using as a political cudgel on Brazil. That put huge downward pressure on assets in the South American nation and upward pressure on the prices of stuff we import into our nation. Katie, that includes airplanes, meat, minerals, coffee, and cocoa. I'm sure you're a fan of all.
All of that, yeah. And you're talking about Conagra, you're talking about Delta. It's a good reminder that earnings season is underway. It never truly ends, but a new season begins. So let's take a look at the expectations here for the second quarter numbers. You look at just in May, where we were relative to where we are now, really steadily coming down over the past 2 months, Romaine. But what I find interesting is whether or not these numbers actually matter. That look back, it's always about the guidance. And in Delta's case, just the fact that there is guidance to give, that seems to be setting the bar here for what we could expect to see over the next couple of weeks.
A great point as we kick you off to the close here on this Thursday afternoon. Julie Biel joins us now, Chief Market Strategist at Kayne, Anderson, Rudnick. And Julie, I think Katie hit it on the head. I mean, what earnings season tells us isn't so much about what we want to know about the second quarter. It's about the confidence that these CEOs and CFOs have about the third quarter and beyond.
Yeah, absolutely. I think people sort of overlook really what's happening. As long as you sort of met your numbers, people are much more focused on the guidance and the near-term outlook. And that's because our job is to be able to discount what's happening in the future and the drivers of that. I think it's pretty tricky right now with this backdrop for most CFOs to come up with any kind of guidance when they don't have a lot of clarity on where tariffs are going to be. So I think that remains kind of a questioning point. And we've all been wanting to see the hard data effects of these tariffs. And I don't think we're really going to get it with that. But what I do think we might get is more indication of business confidence in the form of how are businesses investing? What is CapEx looking like? Outside of the Mag 7, we know they're going to continue to spend the way they have been.
I'm glad you brought that up. I mean, we're talking about a day where NVIDIA, once again, scratching a record high, Microsoft, Oracle, a lot of names in that space that presumably don't have a whole lot of exposure to trade policy, but they certainly have a lot of upside exposure to that CapEx spend. And I am curious as your view on the ROI on that, not only for those folks spending the money, but of course the customers on the other end of that.
Yeah, I think that's the real challenge with AI is that we still don't have really clear business models. What it seems like the best use cases are for driving efficiency and productivity, and that's great. I'm super excited about all of that. But the problem is that the real drivers of technology and adoption typically are things that really help businesses grow the top line. And I haven't seen a lot of business models and use cases that really justify that. So I'm always a little bit suspicious of how much opportunity we have with AI, because what I think is going to happen is that it may take a little bit longer to adopt some of these technologies than we have planned for. And by then, all of this money will have been spent and the ROI might not be there right away.
That is the existential question, one that is looming over this earnings season, whether we're going to see that return on that AI spend. We're talking about corporate fundamentals. I want to talk a little bit about the fundamentals of this economy. You bring up tariffs, and if you take a look at the data that we've gotten, the hard data, you're not necessarily seeing the inflation that was expected. The perspective of St. Louis Fed President Alberto Musalem out today is that it's too soon to tell. Julie, I wonder, though, how you're thinking about that.
Yeah, I think that's the real challenge with a lot of this data is that it's pretty backward looking, and we're going to have so much more noise because so many manufacturers decided to pull forward a lot of inventory, and they're sitting on a lot of inventory. And so the price effects of tariffs may take time. You are seeing some companies at the margin already deciding to take price ahead of tariffs, ahead of that clarity. And I think that that may start to trickle in the second quarter. But I don't really think we're going to have the full effect in view until we're much further down in the year. I think a lot of inventory and retailers have thought a lot about the holiday season, for example, and they've done a great job buying forward their merchandise. So that also probably will not necessarily have a lot of tariff data in it. What's kind of important to understand, though, is do companies decide to take price ahead of it, or do they try to use this as an opportunity to gain market share? I think that's pretty important right now because with margins at all-time highs, we want to be sure that they can stay that way.
And it's interesting. You think about the Delta earnings that we got this morning. I thought it was notable that they were talking about how much they're seeing in terms of international travel, in terms of premium travel. But it's really the economy class in the back of the plane that hasn't seen the demand rebound. And you put that in the context of the economy. There is that concern out there that we are in a K-shaped economy, that the higher end consumer is still doing well, while it's the lower income tiers that maybe are still struggling. Would love to hear your perspective.
Yeah, I think I think the Delta results really confirm a fear that I have, which is if we're just looking at aggregate data, right, consumer spending looks like it's doing okay. But if you break apart the data a little bit more and then you listen to individual retailers, you can see that clearly the high end is doing better and they're spending more than they typically do. So they have been the ones that have been really driving a lot of that growth. The low income consumer is really struggling, and they're going to kind of continue to struggle, right? Because we know that more inflation could be coming to them, but also student loans are suddenly going to come due in a way that they haven't in the last year or so.
Well, I am curious about that point, Julie. I mean, just while you were speaking, there was some breaking news regarding Apple. Mark Gurman reporting that the company is getting ready its slate of products for next year, and included in that is what they're calling a quote-unquote budget iPhone. And it raises a big question here about some of these companies that are selling, I guess, high-value or high-priced products, whether they need to start looking down the price spectrum, given some of the issues that you just pointed out.
I think every company at every income category needs to be looking at the places where they can provide value, because even if you are a very high income consumer, value is something that you've been starved of. Prices have increased everywhere. And I see it across my retailers, even at the very highest end. They're talking about the need to be able to deliver real measurable value where someone says that is worth that much money. And so I think everyone has to be looking and seeing where can I provide a little bit of value that's been completely eroded, and that purchasing power erosion, it creates a really strong psychological effect where people suddenly just don't feel as wealthy as they did before.
Julie, always always a treat. Julie Biel, Chief Market Strategist at Kayne Anderson Rudnick, kicking us off to the close here on this Thursday afternoon. A conversation up ahead on the consumer, on retail and real estate, the intersection of which has been dominated by ARKHOUSE partners. A conversation with Gavriel, Kahane coming up in just a second here about some of the market mispricing in that space.
Plus, from retail to royalties, we'll talk investment opportunities in the media and content space with Sherrese Clarke. She is founder and CEO over at Harbourview Equity Partners.
And the lineup even gets better. An investment playbook outside the U.S. Where do you look, particularly in light of all of the tariff drama? Olga Yangol going to be joining us as well from Credit Agricole. You don't want to miss that. Stick with us. This is The Close on Bloomberg. All right, let's take a look at shares at Dollar Tree. Those shares are actually heading right now for a relatively decent weekly gain since the discount retailer completed its sale of Family Dollar. That deal closed on Monday, unloading the ailing business onto private equity firms for about $1 billion. Now, that's a fraction of the almost $9 billion price paid for the company back in 2015. Now, one of the folks, of course, now leading the charge on Family Dollar is Gavriel Kahane. He's managing partner over at ARKHOUSE, which along with a brigade and a couple of other investors now have control over Family Dollar. What do you plan to do with it?
So the question of what will happen operationally there is probably better for the sponsor brigade to answer, but or John Duskin at McKellum or the CEO, who we're really excited about. That said, I think our interest in the company was primarily driven by a severe undervaluation, in our view, of the great assets there and the growth that the company was actually experiencing. We think it can continue to grow and grow much more quickly, efficiently in the private markets, and we're excited to take it into this new chapter.
I am curious as to when you look at the landscape, and obviously in the past, ARKHOUSE has had a big focus on real estate. Retail, obviously, but real estate has obviously been a big component of that. How are those intersecting right now, given economic conditions, and more importantly, given some of the bankruptcies and some of the other issues we've had with certain retailers?
Yeah, it's a great question. I think what's happening in real estate is an expression not of a change in underlying assets held by REITs or even retailers, which is an interesting expression of undervaluation of hard assets that we should get into as well, but really just a change in the owners of those assets. So pre-GFC, there was almost no correlation between REITs, as an example, and the rest of the market. And that correlation has become perfect, literally almost 1-0.
Wow.
And the reason for that is that the holders of these now asset-rich companies are not really interested in their assets, but they're buying for the sake of growth. They're more focused on, an EPS screen or macro dynamics than they are the balance sheet. And that has created an opportunity for us, as expressed in our interest in the case of Family Dollar and in the case of Macy's, or in the case of REITs that we have, catalyzed privatizations in.
Have you given up on Macy's altogether?
No, I wouldn't say we've given up. They've got our number, and to the extent they're interested in giving their shareholders a big premium, we should talk.
So maybe you'll get a phone call after this segment, but I want to talk a little bit more about REITs, which you bring up. And you mentioned that correlation with the broader market, but even still, REITs, and I'm looking at one of the big U.S. REIT ETFs out there, they tend to trade at a discount to the overall market, and that's consistent if you look year to date, 1 year, 5 year, the list goes on. And what does that say about what the broader investment community is missing in the story that you see?
Yeah, I think that's exactly the illustration of an underlying, I wouldn't say problem, because it just is, it's more of the current status of the demographic of investors moving the public markets today, that they are more interested in fund flows, momentum, passive flows, and less interested in the balance sheets or hard assets of these companies. They're more growth oriented. And fundamentally, real estate is a more buoyed, heavy asset that's just generally less attractive.
And it's interesting to see whether we do see those two come back together. I want to talk a little bit more about what specifically is on your to-do list. I'm taking a look, at IAC, for example. That is a company that you've been involved with. I know that you had a win in late April, getting a board member added after discussions with the company. Give us a status update there. What is still left to do?
Yeah, IAC in our view, represents one of the most compelling mispricing opportunities in the public markets today. On a risk-adjusted basis, it's just astonishing what you can own. We think, it's worth twice where it's trading, and you can very quickly derive the market cap and the EV looking at its liquid assets in cash, U.S. denominated dollars, and MGM stock, totally liquid. You get to $40 a share, where it's trading today. That gives zero value to Dotdash Meredith. That's worth, depending on whose estimates you take, Goldman's, ours, other analysts, $20, $30 a share. Care.com, a great and growing business. Yeah. Turo, a really interesting asset in a quickly changing car share environment. And we're excited that they've been so receptive to our engagement and have taken steps in the right direction towards re-rating and getting their cost of capital.
Is that view specific to IAC, or is this more of a broader indictment of that kind of conglomerate, for lack of a better word, a holding company model?
Yeah, there certainly has persisted for many holdcos, sort of discounts, a discount to the sum of the parts valuation. And it's an interesting question as to whether or not it's necessarily endemic. I would say, in the case of Berkshire Hathaway, shareholders gave that guy a premium for a very long time.
That's fair.
And, interestingly, Barry Diller's had a better track record, over a couple decades period, arguably, in terms of shareholder returns than even Warren Buffett did. And yet, his collection of assets today is trading at half off. So it certainly begs the question of why. In our view, sort of mixed assets always create a complicated story in the public markets. And we think that pure play is certainly much more resonant today. To the extent a company can illustrate to the market that they are taking decisive action to unlock value, to realize out of core assets, to sell off businesses once they've been incubated to maturity, I think the market reprices and gives you a cost of capital with which you can be acquisitive once again.
Well, to your point, we know that spinoffs have been very well received in this current market. Gavriel, have to leave it there. Really appreciate your time.
So soon?
So soon.
Yeah,
I know.
Feel soon. Thank you, Katie.
You'll have to have him back.
Thank you, Romaine. Wonderful to chat.
Gavriel, see you soon, I hope. That is Gavriel Kahane. He is managing partner over at ARKHOUSE. And coming up, shares of Delta are taking off after the airline reinstated its profit outlook for the year. We'll take a closer look at the stock with an analyst who covers the name up next. This is The Close.
Let's get right to our top calls, and we start today with AMD, an upgrade over at HSBC today on the chip maker to buy, a doubling of the price target to 200. That matches a street high bullishness about AI revenue estimates for 2026. Next up, Oracle. Piper Sandler raising its rating to overweight and upping the price target to 270. Why? AI, those shares right now at a record high. And last, let's take a look at Centene. Morgan Stanley downgrading the health insurer to equal weight, slashing the price target by more than half. Some concern about some of the near-term challenges outweighing some of the long-term upside there. Those shares down 1.5%. Let's stay in the sell side and take a look at Delta. That is the star of the show today. Monster gains on the day. It was the first major airline a few months ago to pull its guidance for the year. And apparently today it's the first one to reinstate it. Brandon Oglenski joins us right now, equity research analyst covering the airline sector for Barclays Investment Bank. He's got an overweight rating on the stock. Were you surprised by the reinstatement of the guidance today?
Hey, Romaine, thanks for having us on. Surprised a little bit because we still thought there was a lot of uncertainty out there with travel demand because it pulled back so fast in really early March. But I guess the clarity that they're seeing and some certainty around taxes, the management team is effectively saying, look, we have some visibility into international bookings going into the fourth quarter. Here's a range that we think we can feasibly hit. So I think you're just seeing a relief rally in a sector that really was left behind. I mean, we're still trading at single PEs, even with the move today.
Yeah, absolutely. And you take a look at the stock year to date, I believe it's down for the year. What's interesting to me is what this could say about what we're going to get from some of its peers next week. You take a look at Delta shares today. They're having a wonderful day. United Airlines is doing even better. I know that's in your coverage universe as well. Do you think that we can extrapolate from Delta into some of the airliners next week?
Well, I do, because I think there's some big structural trends taking place right now for the airlines, and it's really this movement of consumers that say, I don't just want a seat from A to B. I want a reliable carrier that's going to get me to my end destination so I don't lose a hotel night or a cruise vacation. And so reliability has become a big thing, network, the ability to flow through hubs. So that's really playing to the advantages of a Delta or United and to some extent American as well. Whereas we see on the lower end of the spectrum where carriers are really struggling with profitability. I mean, Spirit even filed for bankruptcy last fall. The point-to-point low-cost model, which saw a lot of growth last decade, is now actually, we think, losing share to the network airlines. And it goes into like premium products. People are actually paying.
But why are they losing that share? Because there's been a lot of discussion about Southwest and its pivot. It was kind of really the last holdouts of just kind of a straight fare. You get on, you get to where you go, no frills, no muss, no fuss. Now it's just like a hodgepodge of fees like everyone else. Is that contributing to that, or was that going to happen anyway?
Well, I think two issues here. One is the gravitation towards differentiation in travel. So like if you want to go out to eat, there's so many different restaurants. You can go low cost or high cost. And I think that's what Delta tapped into probably about 15 or 18 years ago. They've been on this journey for a long time. I think United's been trying to catch up now for the better part of a decade. But Southwest, arguably where they operate, they have a big schedule. They usually have market dominance. But they were structurally underpricing their business because they were giving consumers something for free that we've been accustomed to paying for everywhere else. That actually resulted in lower fares where Southwest competes.
Well, let's talk about lower fares, and we have less than a minute left here. But when it comes to economy, when it comes to the back of the plane, we know that carriers have been cutting fares to try to help fill planes. Are there any other levers that they can pull here?
Well, I mean, that's what's attributed to about a 5-point pullback in domestic demand since March. And it was very rapid, right around the same time DOGE started coming out. And most airlines said, look, this is attributed to lower leisure demand in domestic U.S. markets. Corporate demand's holding up, premium cabins, so think economy plus and first class, as well as international markets really holding up. So what we're seeing Delta do, pivot in the back half, they're actually going to have main cabin seats declining in the U.S., so trying to better match supply with that demand.
All right, yeah, it's a fine balance, I would imagine. Brandon, great to get your perspective. That is Brandon Oglenski. He is an equity research analyst over at Barclays Investment
I really
Bank.
aspire to the day where I can just not have to deal with the airlines.
Yeah, right.
I mean, maybe I'll get to that.
Get a helicopter, or private jet,
helicopter.
perhaps.
Those can go dangerous.
Yeah, that's true, actually. Those low-flying ones.
Little Cessna or something.
Yeah. All right. Well, we all have things we aspire to. Coming up, I aspire to speak to Sherrese Clarke. She is founder and CEO of Harbourview Equity Partners. We'll speak about where she's finding investment opportunity in this current market. This is The Close.
.30 p.m. in a wet and muggy New York City. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld, and I am just thrilled to be here on a day when the S&P 500 could hit a new record.
It could hit a new record unless you jinx it, Katie Greifeld. It's kind of interesting, though, on this day, it's not necessarily big tech that's leading the charge. A modest bid into NVIDIA on this day as we wait for that $4 trillion mark. But it's like kind of everything else. We were just talking about Delta, and it's not just the airlines, right? It's the cruise lines, a lot of the travel stocks, some optimism that maybe we are still traveling.
Maybe we are. I mean, you certainly see the cruises up as well, which is interesting. And, you know, you break apart the market like you just did, you could get excited that there's pretty good breadth today. Maybe it's a healthy signal that it's not big tech that's pushing us to at least this specific record high. Yeah,
and of course, Delta kind of kicks us off with the earnings season. But I'm really looking a little bit forward into next week and beyond, particularly when you start to get some of the tech companies and some of the media companies like Netflix. We've talked a lot on this show. You remember, you used to host every now and then on The Close. We talk a lot on this show, of course, about the media and about the creator economy. It's become a huge, huge business.
Yeah, and it's interesting. If you take a look at funding, though, there was a great story from The Information about how funding for these specific startups, creator startups, it actually fell in the second quarter. You could ask the question, well, okay, maybe you just see funding overall for startups going down, but we know that AI, for example, is still hot.
Yeah, but what's interesting about that number, and we should point out The Information crunched this data, it was a drop of about 8%. But you know what was actually up? Outside the U.S. In fact, if you look at the data for non-U.S. deals, you actually saw that rising 30% in the quarter. However, a big chunk of that, almost the entire chunk of that, was related to the French AI media company Animaj, which raised $85 million, led by Harbourview Equity Partners. And I'm pleased to say that the founder and CEO of Harbourview joins us right now, Sherrese Clarke. Great to see you, Sherrese.
So great to see you.
Animaj. So when I saw it, I wasn't surprised at all, because anyone who with kids knows not only are these things hot, but everybody wants a piece of it. So we're talking about primarily children, or at least family-friendly content, but with a huge focus on AI-generated content.
Yeah, absolutely.
What does that look like?
Yeah, I mean, I think, listen, thank you again so much for having me here. And in this moment, one of the things that we're really focused on is we're really focused on trying to deliver against audience opportunities that are deep and engaged audience opportunities. Animaj was the perfect opportunity for us to do that. They are a family-focused, kids and family-focused content company, digital first, one of the top 5 on YouTube, over 22 billion views, which all of our children, I'm a mom, I have 2 children, my daughter's almost 13 and my son's almost 10, and they are digital native first, right? And all of us are worried about screen time, all of us are worried about the types of things that they're watching. So what we loved about partnering with Seats and the team is how focused they are on safe, quality content in a closed environment. The leveraging of technology, especially around animation, is something that we see a great business case for using and supporting and enhancing creators, but never replacing them. One of the things that was really interesting for us around investing behind Animaj is a really great proprietary technology, self-developed, in-house developed, to leverage on their own library, so their own IP, not building off of the IP of creators of others, and leveraging that to create digital content quicker, faster, and enabling creators.
And a big part of what you've been doing with Harbourview since you founded it has kind of rested on this idea of finding IP that can be leveraged and maybe licensed out and expanded further. You, of course, most famously started out with a lot of music rights, buying a music rights catalog. Are you still doing that?
We're absolutely doing that. We're closing a deal today. I can't tell you which one.
Oh, come on, you can't.
Because we will announce it in due course, but we are closing a big one today, which we're really excited about. And we continue to see a lot of opportunity sets around all of the things that are centered around IP. Our firm is squarely focused on investing thematically in entertainment, media, and sports. We find that it's a massive industrial complex, but it has less organized capital, particularly for the middle and lower middle market companies or opportunity sets, which we've been able to really sort of square a lane for ourselves around that.
Well, you touched on what I'm wondering about. You mentioned this focus on IP, and I mean, my natural question is, are you interested in a specific genre, a specific type of content, or you just cast a wide net there?
Our net is cast wide against the segments of entertainment, media, and sports. And the reason for that is our denominator is a global audience. We are following audiences. To us, if we follow the audiences, we follow viewership. If we follow viewership or listenership, we follow cash. If we follow cash, we get amazing returns. And with the advent of how technology is engaged with how we all consume media and media content, it is very bespoke to our individual experiences. So identifying content that can speak to multi-audiences is something that we really resonate with. I've often called us the Netflix of the space, right? We really want to have a library where everybody walks in and has an experience that can suit anybody in your family member. Any family member in my household, from my parents to my children, they all have a profile in an environment like Netflix, because they all have something to see and watch. We want to be exposed to things like that have a wide audience around it.
I do want to talk a little bit about your approach to AI, because the concept of AI content, AI-generated content, it's a really hot topic, and there's a lot of people who feel very strongly on both ends of the spectrum. And
I would say I'm an AI skeptic.
Okay.
Really?
I am definitely an AI skeptic as it relates to delivering that last mile. There is nothing like, we just had an experience, we were talking before we came on camera, we just had this amazing experience at the Cannes Lion Festival of Creativity in the south of France, where we were able to bring together our entire ecosystem. Well, every night we had this amazing installation of artistry. Led by Adam Blackstone, who's Grammy Award-winning musical director of Hell's Kitchen, and then layered on top amazing artistry on top of that. At the end of it, I said to the team, AI can't do that. It can't leave you with that feeling. Those instruments, those vocal instruments cannot be computerized. It can't give you that one-to-one. So we are really I am very personally skeptical about that last mile, but I do believe it can be business enhancing. It can help you to animate faster, right? So that doesn't cost you $100 million to make a kids animated series. It can cost you several $1 million, which then opens up the aperture for many more creators of all kinds of audiences to participate in that creation process. So things that enable creators, super excited about. Things that are predatory to creators, we're very much so skeptical of.
It's funny you say that, because earlier today, we were joking in the newsroom. I don't know if you followed, there's an album that's charting on top of Spotify. And it apparently did very well. Most people didn't realize it was AI generated, some kind of alt country rock something, whatever. It was pretty basic. But it gets to this idea that people can be fooled by it. If you don't tell them that it's AI, it's kind of like when you're trying to get somebody to taste something they don't really want to taste, and you just don't tell them what it is.
100%. Listen, again, I am personally the AI skeptic. I was the person that everybody tried to convince to go and buy 1,000 NFTs, and I was like, I really don't understand. I
dodged a bullet.
I definitely dodged a bullet. I was also the person that, we had, I remember ringtones?
Yes.
Remember AI models? I think that at the end of the day, the way that we engage with things that are endemic to who we are as people, as storytelling, it has to have that 3D element, that last mile, that nuance of human language, of human experience that changes candidly daily, moment by moment, by what's happening. And that I think is really, creator-led at the end of the day.
Do you think, though, that with regards to AI, because it's not going away, that we will find this symbiosis between those human creators and that feeling that only humans can give, and the technology, which makes it better?
100%. It's like those of us who were finance, like remember Lotus 1, 2, 3? We all thought people were going to be replaced. When Excel came out, or when people write macros, it's the same thing. Can you have technology that can enhance the experience, that can make it faster, more accessible for you to access and create, but never to replace?
All right.
That's a good place to leave it.
Yeah, absolutely.
Yeah. Well, Sherrese, such a fascinating conversation. Hope to continue it soon. That is Sherrese Clarke. She is founder and CEO of Harbourview Equity Partners. You mentioned that album. We almost got fooled by Bad Bunny, the AI version.
Yeah, we were playing Bad Bunny for one of our producers who's having a birthday, and we pulled up Bad Bunny singing Feliz Cumpleaños, except it was an AI version
I was kind of
of the song, but it sounded okay to me.
I'm not super familiar with his discography, so I was
You're
fooled.
not familiar with Bad Bunny?
No, luckily someone pointed it out, but...
He's having a big concert in Puerto Rico.
Yeah, I would.
It's going to change the economy.
I loved him on SNL. Anyway, there are other things to talk about other than Bad Bunny. We're going to talk about...
During the commercial, I'm going to tell you my story about how I met him right up there on the 64th
maybe we should keep the cameras on for that.
He was a great guy.
Anyway, Ferrero agreeing to buy WK Kellogg for a roughly $3 billion in cash deal. It's today's Stock of the Hour. Up next, this is The Close. Shares of WK Kellogg soaring on confirmation of Ferrero Group's roughly $3 billion deal to buy the cereal producer. That deal expected to close in the second half of this year, and it adds to a streak of recent acquisitions by Ferrero. Let's discuss it all with Bloomberg's Crystal C. I actually want to talk about the overnight trading because this was pretty funny. You saw shares hit $27 overnight. The final bid came in around $23 a share here. So was this just arbitrageurs getting over their skis?
I definitely got some angry messages this morning, and I think maybe the ARBs has deduced that it's closer to like $27.50, but then based on how the enterprise value is calculated, is actually the final price, the transaction price was $23. So there was definitely overnight some excitement, and this morning it was a lot calmer. But yeah, the deal is here. Like Kellogg doesn't exist anymore. Kellogg was one big company, became WK Kellogg, Kellanova. Now both pieces have been sold off to both private companies. Mars had gotten the Kellanova piece, and now you have Ferrero, who's also private. So we're seeing a lot of interest into building a portfolio in the consumer product space.
So this wasn't that much of a surprise. And I mean, the idea is that, when you start to see these separations of companies, particularly legacy companies like this, the idea is that at some point, the whole point is to kind of set it up for a sale. I am curious about this idea of what value, if at all, can be unlocked from this, because wasn't the whole split also supposed to unlock value? And I guess it did. I mean, you get a premium on the day here.
I guess it's like, for me, it's like surprising and not so surprising. Like you said, a separation often is a precursor to further M&A transactions. Now that you're a smaller company, you're more vulnerable. If someone comes knocking at the door with a good premium, you should look at it, and you have no excuse not to. But then also, if you look at the remaining piece, the remaining businesses within WK Kellogg, these are cereals, and Romain, you don't eat cereal. It's not the healthiest. It's like, not the healthiest thing. It's no longer trendy, and and you can
find healthy cereal.
I'm told nobody
terrible.
eats it. Yeah, but healthy cereal, that's kind of against the point, right? And they're being sold to a candy company.
Well, so that's what I'm trying to say. It's that like cereal is not a high growth business either. But if you have a company like Ferrero, and they're so concentrated on cocoa, so concentrated on high sugar and not so healthy for you snacks, it is somewhat of a expansion into healthier categories.
Or maybe they just lean into the fact that it's not healthy, right? It tastes good, right?
Yeah, indulgent. Cereal, perhaps. Spitting out some ideas here.
Yeah, little. I like the way you think.
Thank you.
I like the cut of your jib.
Crystal, really interesting stuff. That is Bloomberg's Crystal C on that deal. We'll see what.
What's your favorite cereal, Katie Greif?
Kashi. Some people call it kashi.
Is that a cereal?
It's high fiber, high protein.
That's not a
12
cereal.
grams of both in a serving. It's amazing.
All right, when we come back, we're going to bring Matt Rowe into the conversation over in Man Group. This is The Close on Bloomberg. Just 10 minutes until those closing bells. Romain Bostic alongside Katie Greifeld and S&P 500. Right now, clinging just barely, I believe, to a record high, just by, looks like just barely a point or two.
That's true, and a lot can happen in 10 minutes, but if we stay roughly around these levels, maybe we'll get there. I did want to pull up the Russell 2000 as well. I thought it was interesting to see the small caps outperforming today. I don't have a satisfying reason for why, but did want to highlight that. You also have the VIX draining right now. I keep using that word when it comes to volatility because that's what it feels like, Romain. We're trading below 16 on the VIX, and Bitcoin also popping off, up about 2.3% right now. So really a risk-on day. Yeah,
definitely risk-on, certainly at the bottom of your screen. I'm glad you brought up the Russell, though, too, because we've actually seen over the last few sessions some meaningful outperformance by the Russell, the S&P mid-caps, and a lot of those kind of cyclical, economically sensitive stocks. And I wonder if that is a function of people being a little bit more, sanguine about the tariff situation and the economic situation, and feeling like, at least for right now, everything's going to be okay.
You know, they clown me on open interest for always bringing up the Russell 2000, so a real meeting of the minds.
Well, you know, I watch your show every morning, and one of your other coinkers, for some reason, keeps bringing up
the Dow.
The Dow.
Where'd that come from?
So anyway, let's keep it moving here as we get closer to those closing bells. The Dow up about 0.5% right now. The S&P up 0.25%. Matt Rowe joins us around the table, senior portfolio manager with Man Group. Let's talk about that outperformance, relative outperformance we've seen as of late among some of those more cyclical names. And some of that has been in kind of the consumer-facing retail apparel space. And I wonder if that's more a function of sort of a rebound rally for those names that had outsized exposure to tariffs and the bet now that maybe those tariffs won't be as bad as we had originally thought.
Yeah, I think there is some of that because there hasn't been real tangible negative impact yet. Even Delta coming out today and saying that the environment looks fine, right? Like that, what really spooked the market during Liberation Day version 1 or round 1 in early April was that they pulled their guidance. And now they're saying that things look okay. So I think you're starting to see evidence that companies feel relatively okay about it. I also think the point about Russell outperformance, later stage rallies tend to see people reaching for risk and buying things that are still cheap. So you're seeing what they jokingly refer to as the dash for trash, and I don't mean that in a derogatory term or a derogatory way.
It's okay.
But if you look at factor performance since the trough post-April Liberation Day, the number one performing factor is high default risk stocks, which tells you that people are buying risky assets, right? They're willing to take risk. And so I think that's kind of evidence that investors are continuing to chase the rally and looking for new ways to extend that.
This gets to the idea, though, and I'm glad you used the idea of dash for trash, because we were having this conversation yesterday in the newsroom when everyone was talking about NVIDIA hitting that 4 trillion mark and kind of what this was a symbol of. The same day you saw Bitcoin hit a record high. So you have kind of some of the, let's just say, some of the highest valuation assets out there hitting fresh records, and a lot of people are asking why. Is there a fundamental reason for that, or is this just the FOMO and people just chasing the rally?
Yeah. Well, I think it's both. I think there is a fundamental reason for it, and I do think that people are chasing a rally, and because there's a little bit of, oh man, look, the Nasdaq's up over 30% in the last few months, and I missed it. But I do think the fundamental reason is, not to get overly statistical about this, but there's the notion of sort of a trinomial tree, or the distribution of a potential stock, right? You're range bound by zero, which you can lose, but growth companies and momentum companies can multiply. They don't have just low single-digit linear growth. They sometimes can create multiplicative growth, and I think people are looking for areas where they can get sort of outsized positive returns, and they're willing to ignore the downside risk for the moment. And I think that's the real shift, is that people have taken away the fear of the downside, and now they're looking for things that have the potential to go up more than the rest of the market.
By the way, that was the first mention of trinomial tree ever on the close.
Write that down. Write that down. When you're talking, though, about not appreciating the downside risk, is that what's happening in consumer discretionary stocks? I'm taking a look at the notes you sent over to our producers. You say that rally is uniquely out of touch, and I haven't seen that description applied to consumer discretionary stocks before.
Yeah, I mean, I think if you look at thus far, the impact of tariffs has been relatively low. But we're just now starting to get to the point where that may start appearing. When the tariff rate is really starting to show up in the consumer spending. The effective tariff rate for the U.S. pre-April 1 was about 2.2%. As we stand here today, it's just under 9%. So even though we've seen this date sort of pushed out for sort of the end of negotiations, and when the game is over, the actual effective rate is over 3 times what it was. That's going to have an impact somewhere, whether it's on the bottom line of companies, whether it's in decreased consumer spending. It's going to show up somewhere. It may just take a little bit of time. And I think that consumer discretionary companies broadly are likely to see a softening in the back half of the year, because look, Amazon's Prime Day, or Prime 4 days as it is now, will be a big tell where that's concerned.
Yeah, well, so far I think we're 2 days into the 4-day Prime Day. It hasn't been looking too
40% drop on that first
day. Not too pretty, not what you would want to see. So, okay, consumer discretionary, it sounds like that's a place to avoid. Where are you finding the opportunity then? Where can you say, I feel really good about this sector of the market?
Yeah, so we think, relatively speaking, taking profits in U.S. that you've benefited from in the last few months and rotating into relatively cheaper assets in Europe, for example, make a whole lot of sense. We think that there are certain pockets in credit where you can really get paid for the risk that you're taking. And I should clarify, when I say that I don't like consumer discretionary, it's on a relative basis, because right behind the high default risk factor is consumer discretionary. It's up 44% since the low at the beginning of April. So the reason why I don't like it is more so because of how far it's run and that fast. But I do like opportunities in credit. We're seeing a lot of things in the private credit space that continue to look attractive. So look, I grew up in a world as a volatility person where all forms of long risk are short volatility trades, and you just have to figure out where you're being compensated best for taking that risk. And so I constantly am scanning back and forth for what looks best.
All right, well, one of the best in the business, Matt Rowe. And by the way, love your lapel pin there.
I have to give you credit for the reference, I probably can't say the name of the place, but I'll leave that up to you.
Well, I'll say it, M&S Schmalberg. I'll give a shout out to them, great folks here in Midtown Manhattan. Our thanks there to Matt Rowe, Senior Portfolio Manager with Man Group, counting us down to the closing bells. Katie Greifeld with the S&P 500, 62.79 and change, just barely a record high.
Just barely. We'll see if we get there again. A lot can happen, but you take a look at the market. We're talking about
You keep saying a lot can happen. Are you expecting something to happen?
I don't know. I don't want to jinx it, but pretty good breath.
62.79.35 is the key number to watch for. A full breakdown starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld, taking you through to the closing bell with a global simulcast. It starts now. Carol Massar in the radio booth alongside Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube. And I'm going to give you the headline number, Carol Massar.
What?
6280.32. That is where the S&P is right now, just barely a point above its record high.
July 3rd, 6279.35. So, yeah, we'll see whether or not we will keep it there. Right now, it's just fractionally above. We're going to see. I got to tell you, airlines doing their job trying to push or they have pushed the market a lot higher. That is some outperformance in that sector, but we'll see whether or not it's enough to give the S&P another record. Can I just point? Airlines are up 11% as a group today.
Yeah, United up 14, Delta up 12, even Southwest, little old Southwest up 8%.
Yeah, it's pretty remarkable. I mean, there's a risk-on mood sort of taking markets. We saw a new record for Bitcoin, now up above 113,000. Just in the last 3 days, Katie, Bitcoin up 5%.
I know you've been following that closely as the co-host of Bloomberg Crypto. Also adding to that risk-on mood, the VIX, as we've been talking about. The VIX trading with a 15 handle. How low can it go? I don't know.
How low can it go? I do just want to point out, too, there is still some concern in this market, particularly when it comes to tariffs. We had the earnings this morning out of ConAgra. That was a big miss with regards to the guidance, and that was directly related to tariffs. And also should point out that a lot of the stocks overseas that are affected by tariffs, particularly in Brazil, really under pressure today, like Embraer, some of the meatpacking companies, as well as we still keep a focus right now on trade policy and how that could upend this record rally. Let's walk you through the numbers. And we're going to start with Katie's favorite, the Dow Jones Industrial Average, up a cap-weighted index, up more than 190 points on the day. It's going to close higher by about 0.4%. The Nasdaq Composite up 20 points, or 0.1%. And let's take a look at the S&P 500. It takes a while for these numbers to settle, but right now, 62.8037. If that holds, that will be a record high, up about 0.3% on the day. Remember, the last record high was right around 62.7930 and change. So it looks like we are going to close above that level. The Russell 2000 getting in on the action as well. The relative outperformer up 0.5%.
Kind of amazing, just barely a record, but it still makes it a record. So as it settles in, it does look like another record close for the S&P. Having said that, digging down into the index, Katie, you've got 352 names in the S&P 500 gaining ground on this Thursday, 149 to the downside and 2 unchanged.
Yeah, big broad gains. Tim said risk on, and this is what it looks like. If you take a look at the sector level as well, you had 9 sectors in the green. You had just 2 in the red. Consumer discretionary was your biggest points gainer when it comes to that. I think this is a really healthy sign, and I think a lot of people would agree with me. You hit this record just barely.
If she says so herself.
If I say so myself.
If you disagree, get in touch.
Or don't, that's fine. Yeah. But anyway, we hit this record high.
Katie Greifeld at Bloomberg.net.
That's even with tech falling on the day.
Phone number? No.
So it's not just big tech that's propping up the rally here.
All right.
Katie's getting flashbacks to when she was anchoring the show permanently. She just knows you just got to move forward when everybody interrupts you. You just got to keep going.
Keep going, keep going. All right, let's get to some of the individual gainers.
Sorry, was that a reference to me?
No, yes.
Okay.
Well, all right, airlines, we talked about outperformance. Delta Airlines, the reason why this one up about 12% here at the close. It's actually the number 2 gainer in the S&P. United beat it out, up 14%. United also hinting, was it last night, yesterday?
Yeah, last night with the 8K.
Giving out a little bit in terms of some financials, so kind of teasing ahead of those Delta earnings this morning. But nonetheless, Delta up about 12% here in today's session. We know the news, reinstated a profit outlook for the year, expecting an adjusted profit of $5.25 to $6.25 a share. The CEO talking about travelers coming back, corporate travel strengthening. So the whole group to the upside. Got to talk about MP Materials. Man, this one was up 50% in today's session. It's a rare earth magnet producer, and it struck a multi-billion-dollar public-private deal, actually, with the Department of Defense. They're going to build a new magnet plant. They're also going to expand rare earth capabilities, backed by $400 million in equity and a $1 billion loan loan commitment. We actually talked to the co-founder and CEO. We talked about that 3-part investment. It's kind of fascinating. He talked about how it's going to really up their capabilities in terms of production, but we had a lot of questions about what it means about whether or not this is becoming a state-owned enterprise.
I caught a big part of the interview, but I couldn't hear the end of it. Did he talk about when we're actually going to start seeing stuff actually come out the ground?
We actually ran out of time. We talked about it with Joe Doe afterwards. But what Joe Doe said, that there was a 12-month, I believe, schedule in terms of when it's going to come out. They've laid some of that out. So, yeah. So about a year, but they've kind of put some of this stuff out there, right? Didn't he say 12 months?
The mine has been around for 70 years, though. So.
Yeah. Okay. All right. You
can keep going.
I know. All right.
Don't you have another one?
No, she loves her pauses.
Man, pop the bubble.
Is that it?
The balloon. No.
That's it.
Okay.
No, Ramaco Resources. I got another one. Small market cap shares were up about 30% in today's session. If you don't know the ticker, it's METC. Fluor completed a preliminary economic assessment of the company's Brook mine located in Wyoming. This is a mine that also has rare earth elements. It's basically going to have to separate those rare earth elements, they're heavy elements, from coal. So there's a lot going on. Why are you guys all looking at me so strange? We did talk to the company's CEO, Randall Atkins. So, yeah, it's a really interesting interview. You guys are just
I was just thinking about
my
introduction to geology course in college and how it's coming in so useful when you're talking about these
I'm just saying,
rare
we
earths.
did a lot of conversations about rare earth and like the government being very actively involved with some of the companies.
I think you could say we dug deep today.
Okay.
For rare
Don't
earths.
go there.
All right.
I
that's
just
enough.
got to
Oh,
mention.
you have another one?
Yeah. Well, you took.
Guys, like,
Okay.
the simulcast is almost over.
Sorry.
All
Go
right.
ahead, Carol.
I'm moving on. I'm done.
Thank you.
I'm done. I'm done.
Timothy.
I'm out. I'm so out. I'm so out. All yours, baby.
All right, let's go with Vertiv Holdings. This company fell 6% today. It's actually down as much as 14% earlier in the session. The company provides data center cooling solutions, and shares fell after Amazon's AWS builds now equipment designed to cool NVIDIA's Blackwell GPUs. Analysts are concerned that, the growth of this company may suffer if Amazon is actually coming out with a product similar to what it does. Bloomberg intelligence analyst Mustafa Oker said AWS rolling out its own server liquid cooling system could weigh on Vertiv's future growth prospects. Once again, shares fell by about 6%. Autodesk, among the worst performers in the S&P 500 today. Bloomberg News reported that the company is weighing an acquisition of the rival software provider PTC Inc. That's according to people familiar with the matter. Interestingly enough, shares of PTC also fell more than Autodesk today, down 7.6%. And finally, Carol mentioned airlines doing well. What about this company, Embraer? You brought it up, Romaine, the concern about those tariffs on Brazil. ADRs fell 4.7% today after President Trump said he will impose 50% tariffs on goods from the country. Jefferies is estimating that U.S. tariffs would add about $350 million to the cost of a jet from Embraer. We talked to Sheila Kayalu of Jefferies earlier. She said Textron could actually be a winner from this. They make Bell, Cessna, Beechcraft, and Hawker aircraft and compete with Embraer. Also, watch American Airlines, she said, because they're at risk to pay more given the backlog. They've got 90 of these jets on order out of an order book of about 250 aircraft.
All right, let's get a quick check on yields. A relatively subdued day despite some trepidation heading into today because of the 30-year auction that seemed to do okay. You see the divergence, though, in yields, and that's going to continue to be a big part of the story. Looking at that 30-year yield, just ever so slightly down. In fact, we'll just call it unchanged on the day. But, of course, the real value out there today, guys, isn't in financial markets. It's in the auction market.
Yes.
The original Birkin bag, the original Birkin bag.
I know.
Sold.
Romaine, I want to say thank you so much. I can't wait to get it. Thank you. I know it cost you $10 million, but it was the one that Jane Birkin owned. It was made about 40 years ago. There's a great story about her being on a plane, and an executive, I believe it was from Hermes, and kind of said, she used to carry a basket around, with all her stuff. And she's like, could you make me a bag that could carry all my stuff? And she actually, drew it on, I think, a vomit bag.
Really?
On the airplane.
Yeah, what I love about this, too, is, they talk about the seller, this woman, Catherine B., who basically runs a very famous boutique store in Paris that specializes in vintage handbags. She bought this bag years ago, no one seems to know the exact price for it, but she picked it up at auction. Presumably, she made a pretty healthy profit on it. I think I saw an interview with her today in the New York Times where she basically said that this was by far her biggest deal of all time.
I bet it was. She kept it in like a safe. I think the temperatures were controlled. There were little angels around it singing, oh, like it was really good stuff.
Wow.
Wow.
This was fun. I haven't done this in a while.
Yeah. You should come back tomorrow.
Yeah, I will.
I will not be back tomorrow.
I think I have like an original, Ralph Lauren wallet from when I was a teenager.
Not the same, baby.
Would that go for anything?
Not the same. I'm just going to say, well, whenever you want to give us the
old
Birkin.
bottle of Dracar Noir.
Oh, now you're bringing back memories.
Taco Rabon.
Did you really wear that?
I was a teenager once.
Oh my God.
We all were.
We just learned so much about it.
Just an awkward, silly teenager.
Okay, that is a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. We do it all, everybody. I will not be back until about a week or so. I'm going to take a little vacation time.
Have fun. We will miss you.
I hope you will.
All right.
Listen, just take care of the universe, okay, for us, everybody? All right. They're going to continue on TV. We're going to continue on radio. We, or some of us, will see you again, same time, same place tomorrow.
Our coverage continues here on Bloomberg Television. When we come back, Tony Crescenzi over at Pimco joins us. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm seated Romaine Bostic as we take a look at markets that did, well, what everybody wanted it to do. Close at a record high. The S&P 500 just doing it by only about a point, but as we know, it is not necessarily the gap between where the last record was and the new one was is the fact that it hit it up 0.3% on the day. But the big star of the show today was Dow Transport. It's the biggest outperformers that we've seen in that average relative to the broader market in at least 3 months. And that, of course, was on the back of some relatively bullish comments by Ed Bastian, the CEO over at Delta, who reinstated the company's annual guidance and showed a great deal of confidence about what he saw as bullish travel trends for the rest of the year. Meanwhile, though, risk does still persist, and you see that reflected on the third line of the screen there, Katie. That is one of the main ETFs that tracks Brazilian stocks, which continue to slip, as does several other Brazilian assets. Still a lot of concern about U.S. tariffs.
Absolutely. You're not seeing it when it comes to Levi Strauss, one of the companies that you might have thought would be impacted by tariffs, but we just got earnings for this company. Let me bring you the details now. It boosted its full-year net revenue forecast. This is why you're seeing shares rise 10% now after hours. Levi Strauss sees full year net revenue growing between 1 to 2%. You compare that to the previous look, the expectation of actually negative growth, -1 to 2%. So they basically took away the minus, and that's why you're seeing shares really take off in the aftermarket. Romaine, I will say that this is a company that had a pretty high bar through today's close. Shares are up about 16% on a total return basis. So really knocking it out of the park here.
Absolutely. And a key quote in that release is the idea here that given all that momentum and despite the higher tariffs, they have the confidence to raise their full year revenue guidance. And that does bring us to our top story of this hour. And that, quite frankly, is the mix right now between sometimes contradictory market signals and catalysts. And on one hand, have actually put a floor under asset prices, but at the same time, maybe might be putting a cap on them as well. Despite the record high in stocks, Daniel Skelly, lead strategist at Morgan Stanley Wealth Management, sees a range-bound equity market for the rest of the year as the S&P sits about 4% above the average of year-end targets predicted by Wall Street. And that narrow range, it looks even narrower when you go into the fixed income space. That's maybe not a bad thing, though. For bond investors, you're still collecting 3.9% on 2-year bills, maybe 4.3 or so on a 10-year note. And since fixed income strategy ultimately involves staying ahead of forward interest rates, a Fed that's in stasis today and then potentially one that moves yields lower in the future, that might provide some ample opportunity to enter this market for some investors. Tony Crescenzi joins us right now. He's the bond market strategist over at Pimco, and he joins us here in Studio 2. And that is where I want to start. Is where are you finding opportunity?
Well, everywhere. It's a very target-rich climate for fixed income investors, and I've been in the bond market, so to speak, for more than 30 years. And you'd have to compare today's yields, which are between 5 and 7%, on high quality fixed income, AA minus average credit quality, which means, according to Moody's and the history, a 99.98% chance of getting your money back. So very high yields relative to the risk. And by the way, that yield is quite high relative to the S&P 500's dividend, which going back more than 200 years is near a record low of 1.2%. So it's a very target-rich climate. We're finding opportunities broadly. It's a $140 trillion global supermarket of bonds to invest in. So lots of aisles to shop in, lots of shelves to look at in those aisles, depending on the segment of the bond market.
When you look at that return differential between what you can get in the fixed income space, particularly in corporate credit relative to equities, do you think that differential will continue to favor fixed income going forward?
Well, favor is a tricky word, of course. Fixed income, of course, is a diversifying asset, and so that's one of the key features of it, along with income and the protection of your principal. But it's probably going to be attractive relative to equities for some time, in the sense that over a market cycle, bad things can happen to the equity market, providing fixed income investors a benefit, of course, when they hold them. So there's always a benefit to having fixed income in Pimco's way of seeing things. And so, especially with these yields, it's in a sense a nirvana for bond investors. With the yield today between 5 and 7%, as I mentioned, it's better than the 10-year average, which is somewhere in the 2s. And I'd have to go back to beyond a 20-year average, 30-year average, to a 40-year average to find a yield that's more compelling. So it's very attractive relative to history. Expected inflation, that's a bit debatable. We think it'll get into the 2s next year, 2 point something. And expected volatility, which is really important to judging the return prospect, because the real way to judge the returns is to look at the expected return versus expected volatility. And when you divide the two for bonds, it looks very good relative to equities. And so with equities priced for perfection, it's a good time to be in fixed income.
I mean, to that point, though, Tony, I was speaking to Rick Reeder of BlackRock last Monday, actually, and he compared equities to long duration debt, so the long end of the Treasury curve. He said he'd rather be in equities right now. We're talking about the long end, though, and it feels like that has been really, really unloved. When are the stars going to align? When are we going to see nirvana at the long end of the curve?
Well, the idea of rather be in equities depends. This is significant volatility. What if you're 65 years old and you have a 20% drawdown in equities? I'd rather not be in equities at that time. So it really depends on the investor's expectations, its needs, et cetera. But in terms of the 30-year bond and longer-term interest rates, it depends. We know that Washington keeps kicking the can down the road with respect to the fiscal problem that the United States has, and so you might have to wait till the 2028 election for any real solution on that. So you could expect the yield curve to continue to steepen. So Pimco would recommend investing in the middle part of the yield curve, the 5 to 10-year portion of the curve.
The belly, if you will.
In fact, if you want a long bond, think of the long bond of the short end. The 5-year Treasury tends to perform well when the Federal Reserve is cutting its policy rate, and we expect that it will. And when the yield curve is steepening, the 5-year point historically tends to be the top performing point on the curve.
Well, really quickly here, Tony, let's talk a little bit about the extreme short end, because money market funds just keep sucking in cash. And I have to imagine for a lot of fixed income managers, a lot of active managers, that has to be so frustrating just seeing this demand that there is just for pure cash right now.
Well, I would say run, don't walk from cash to core, which means that those intermediate maturities, because those yields, this nirvana and the short end of the yield curve, if you think you're avoiding volatility, can be fleeting. At some point, the Federal Reserve could be lowering your interest rates. One final point. Americans, households were masterful about locking in low mortgage rates. They should be masterful again about locking in higher, longer-term interest rates, those intermediate rates that I talked about. It's, in a sense, you could say like a double lock is the way I like to think of it. Locking in the low interest rate on the debt that that households have to pay, and of course locking in higher income through higher interest rates that exist today.
All right, Tony, got to leave it there. Fantastic to catch up with you.
Great to see you both.
That is Tony Crescenzi. He is a bond market strategist over at Pimco. And let's stay exactly on this theme, but look at it through the lens of ETFs, because investors in that segment of the market increasingly embracing short-term debt. You have actually SGov. It's a BlackRock ETF that tracks 1 to 3 month Treasury bills. It's actually surpassed TLT. That tracks 20-plus year Treasury bonds, and they actually have surpassed when it comes to the short end. So let's break it down with Bloomberg's Emily Grafeo. I love this story because it feels like a real sign of the times that you just have this insatiable demand for cash, and TLT has been breaking so many hearts over the past couple of years.
It has been. It's been now infamously dubbed the Widowmaker because people have been piling into this fund, and it's returned it's down 40% on a total return basis over the last 5 years. It just hasn't worked as a trade, and particularly, it's just not that attractive for investors right now when you can get those yields, think 4% in the shorter end. SGov is actually the second best ETF for inflows this year, right behind the S&P 500. So out of all ETFs, equity and fixed income, people are really piling into that short end.
I mean, I understand why that yield looks attractive, but when you start to think about, obviously, things like rollover risk and stuff, and I know that's not necessarily a direct thing with the ETFs, but the idea that at some point, and if you listen to what Tony had to say, that if we do sort of come out of this environment, do you want to be in a position where you're being stopped out on a short-term bill, or do you want to be locked into something like in the belly of the curve?
Well, the belly of the curve, I mean, that's not really you can't really get that in one of these ETFs. Okay. But I have heard that.
It's just long short.
Yeah, I mean, here we're just talking about the super short end and then the super long end. But at least for right now, we are seeing people pile into money market funds. We are seeing people pile into that shorter end because they've learned that the volatility isn't worth it. And Eric Balchunas of Bloomberg Intelligence, he has such a poetic way. He hates TLT, but he says you kind of need to it's for people who like to overthink things if you want to be in TLT, because so many things have to go right for that long duration trade to work. The Fed needs to cut. We have to have a severe economic downturn, and then treasuries have to work as a safe haven bid. And we can't have rising inflation, rising deficit fears. And of course, that's been a talk on Wall Street right now with the big, beautiful bill, with potential tariffs. Rates could go up on the long end.
All right, Emily Grafeo, a lot of risk and a lot of opportunities in the fixed income space. A great column by her the other day on the differences that we're seeing in flows into the shorter end of the Treasury curve and the longer end of the Treasury curve. We'll be back in a moment. This is Bloomberg.
If Apple wants to get bold, it has the money to get bold in data centers. It has the money to buy all the engineering talent and all the various other startups around to build an AI. But they have to get bold and they have to make some big decisions.
The co-inventor of the iPod speaking on Bloomberg earlier today. A lot of questions about Apple's strategy going forward on new products and on AI. Lightshed Partners calling for the iPhone maker to actually consider replacing CEO Tim Cook. Mark Gurman joins us right now, who covers everything Apple for us as managing editor of Consumer Tech. And I know, Mark, this has been the parlor game now for quite some time. But when you consider Apple's performance, is there a case to be made for replacing him? I mean, the stock's done okay.
As I said on Bloomberg yesterday, it's a blasphemous assertion. There's no case for replacing Tim Cook as Apple's CEO. The issue isn't necessarily his leadership, but the issue is among the decision makers below Tim Cook, who made some of the decisions in terms of how far to push into AI, how far not to push into AI, the investment decisions into GPUs. Obviously, the buck stops with Cook, and he's the one who puts these people in place. But he's also the person who's going to fix this thing, I believe, and put the right people in place. I'm expecting a pretty big management overhaul over the next couple of years at Apple. I'm expecting a large swath of changes to the way the company's organized, the way the company thinks about things, the way the company functions. It needs an overhaul, but that does not include replacing the person in charge.
All right, point taken there. I do want to talk a little bit about potential M&A here. I know that you've written on it. And then we had a note out from Dan Ives over at Wedbush earlier in the week, which caught a lot of eyeballs, that basically his view is that Perplexity, Apple should buy Perplexity. He described it as a no-brainer. Are we ever going to see Apple pursue a real big-ticket purchase here?
Yeah, my take is that Ives has been reading my work for the past several years, including the past couple of weeks where I've been talking about Apple. Yes, how Apple has been seriously considering purchasing Perplexity. I reported on that 2 weeks ago and laid out in my Power On column a case for why Apple should buy Perplexity. So definitely Perplexity is very high up on Apple's radar. There's a few others as well. Other companies I talked about include Mistral. That's a Europe-based maker of large language models. So certainly making big, bold acquisitions is going to be part of this AI turnaround strategy. Apple just needs to get that green light from Tim Cook as he evaluates exactly what the path forward is.
Yeah, absolutely. Everyone looks at that cash pile and they wonder why they're not spending it, whether it's on actual companies or in the case of people, as you said, maybe they want to shell out a couple $100 million to keep some of those AI folks around. Mark Gurman, of course, smartest man in the building when it comes to Apple. A great story out earlier in the week and a great story today on some new products maybe coming down the pike for 2026. When we come back, we're going to talk about the tariff situation, which, of course, may affect that product pipeline. A focus on emerging markets with all eyes on Brazil and all eyes on Africa. Those conversations coming up after the break, right here on The Close on Bloomberg.
First of all, the Brazil is a one-off. It's a very unusual talk about tariff because it doesn't have to do with imports and exports. It has to do with President Trump's anger at the way the Brazilian government is treating the former leader, Bolsonaro.
Wilbur Ross, the former U.S. Commerce Secretary, speaking earlier on Bloomberg about Trump's 50% tariff that he's threatening to levy against Brazil. We saw 1 month implied volatility in the Brazilian real jump to the highest in 3 months. We saw, of course, equity assets over in that country plunge for a second straight day. Here to discuss what comes next is Olga Yangol, head of EM research and strategy for the Americas at Credit Agricole CIB. Olga, Wilbur Ross says this is a one-off. He says this is more about Trump's politics and some of the political issues he has going on with an investigation going on into the former Brazilian president, Bolsonaro. Nevertheless, we've seen the impact in markets for a market and for a Brazilian market that prior to yesterday had actually been doing relatively well this year.
Right, indeed. And I would agree with Wilbur Ross that it is mainly political. Indeed, we have a trade surplus with Brazil, and in the letter that President Trump posted, the first point that he mentioned was relating to Bolsonaro. But year to date, Brazilian assets have done very well, and we actually think it should continue unless this Rowe escalates. Now, admittedly, over the past 3 months, the story of the Brazilian real in particular was more about weaker dollar, the sell America or hedge America trade. Going forward, we expect that the dollar will stabilize, but what Brazil has to offer is very high real yields. We have 15% policy rate, adjusted for inflation. It's one of the highest in EM.
So you mentioned, the CELIC, I mean, we're at 15% there. Do you anticipate, though, given some of the commentary we've heard from the central bank in recent meetings, that rate is going to go down sometime soon?
Our expectation is that the policy rate will stay on hold until the end of the year, and then perhaps sometime next year they should be able to lower it. Our forecast for the end of next year is 13%. What we actually seeing is that the President Lula has become more supportive, or at least not contradicting the central bank in their tight monetary policy stance, because inflation has been increasing and inflation expectations have been rising. And if you might recall, during U.S. elections, we had a Joe Biden problem where even though the economy was doing well, inflation was eating into real incomes, and that's what the president in Brazil is trying to avoid as well, heading into next year's elections.
Right, so they have a big election next year. I guess, first of all, from an investment standpoint, were you surprised at Lula's positions up until now with regards to not only monetary policy, but also fiscal policies? And given the developments now with Trump beefing with him, does this sort of, I don't want to say solidify, but this sort of give him a little bit more wind at his back for another term?
Yes, indeed. You know, it might potentially help Lula at this time. I wasn't necessarily surprised by the policies of Lula. We've seen Lula during the prior 2 terms, and we know where the Workers' Party stands on fiscal expansion, etc. However, this year there's been some fiscal consolidation, and things have been going well. Now, Lula, as I've mentioned earlier, suffered towards the end of last year in ratings because of the fall in real incomes due to rising inflation. But as of late, we've seen him improving in the polls. And now we've seen this in Canada, right?
Yeah.
We've seen that picking a fight with the U.S. president seems to help you win elections. So perhaps this could be the case as well.
Yeah, there are a lot of people say that Mark Carney would not exist right now as leader of that country if it weren't for the spat that he started with Trudeau. Speaking of which, I am curious about Mexico. I mean, we've kind of forgotten about them, although they're also in the president's crosshairs. I guess he's been too busy with other countries. Claudia Sheinbaum so far has done a relatively decent job in navigating the political environment. Do you see investment risk there, major investment risk there, because of the fractured relationship with the U.S.?
So in case of Mexico, I have been surprised, given that the rhetoric of Trump towards Mexico was a lot more belligerent. And we've seen how relatively collaborative both parties were. Now, probably we should be giving credit to Claudia Sheinbaum more than to President Trump. But going forward, I would say indeed, so far it seems that the risks from tariffs or relations from the U.S. have been somewhat mitigated. I still think that we're not out of the woods, given that U.S. President is clear about wanting to reshore the auto industry back to the U.S.
Yeah.
However, we do see that growth this year in Mexico will stall.
Yeah.
And at some point, we expect that there will be continued decline in policy rates. So in that sense, we expect that the Mexican peso will depreciate. Now, this is no longer because we're necessarily expecting Armageddon with respect to trade.
Yeah.
It's more about other macroeconomic considerations.
And we should point out today we're actually seeing one of the main ETFs, main indexes that tracks emerging market currencies. That's right now closing lower, longest losing streak of the year. Broad EM. When we talk about flows, there was a lot of talk about American exceptionalism being dinged, and this idea that money that would have gone to the U.S. was going into other countries, developed markets overseas, as well as a lot of emerging markets. And you saw that reflected in the MSCI MXEF index, as well as other indexes. Do you worry at all we could see a reversal of those flows, meaning people will start coming back into the U.S., assuming the political chaos dies down here?
In fact, this is our latest thesis that with the passage of the big, beautiful bill and seeing quite resilient hard data, admittedly, just at the beginning of the second half of this year, we actually becoming quite positive on the U.S. We expect growth to accelerate next year. And in terms of what you just referred to, the Sell America trend, what we're actually seeing in the data in terms of net inflows, they have continued to be positive. They have been increasing at a slower pace, but they have been net positive into treasuries, agencies, U.S. credit, and equities. And now, with the arrival of this massive fiscal stimulus, we think that there could be once again renewed interest in U.S. assets. And another variable, of course, to the extent that we also see trade uncertainty dissipate, that could be quite a positive for U.S. dollar and a negative for EM.
Right, Olga, great. Oh, great stuff. Olga Yangol is head of EM Research and Strategy for the Americas at Credit Agricole CIB. And of course, as Trump, at least for right now, tries to sort of deal with the issues going on right now with his trading partners in Latin America, he's actually trying to improve the U.S. relationship with Africa. It's a key touch point in this week's trade developments. The president telling West and Central African leaders who are in the U.S. this week that he would go from aid to trade in his effort to expand the economic relationship in the region, which of course is home to substantial deposits of critical minerals that the president has made no bones about that he wants to get his hands on. Joining us right now is Dr. Landry Signe. He's senior fellow at the Brookings Institute, and he has spent his life's work researching the transformation of African economies. Doctor, great to have you here on the program. What does a shift from aid, meaning aid that the United States has cut off to many African nations, and a shift to trade relationships that, quite frankly, have not yet been started, what does that process, if at all, look like to you?
Thank you very much for having me. So it is extremely important to put things in context. Even during the first Trump administration. So the administration launched Prosper Africa, which was an initiative coordinating many U.S. agencies and aiming to increase two-way trade and investment between the United States and Africa. So it is not really new, the approach on focusing on trade, on focusing on investment. So what is new here when we speak about U.S. foreign policy in general? I like to think about four key drivers. The first one is prosperity. So how to unlock trade, investment, commercial diplomacy abroad. The second one is power, the geopolitical competition with China. China is now outperforming the United States in terms in Africa, in terms of influence in numerous countries, including in trade and investment. The third one...
But hang on one second, Doctor. I want to stop on that second one, because when we talk about power, I mean, anyone who has traveled through Africa, particularly West Africa, even in some of the Eastern African nations, the Chinese presence is huge. You do not necessarily see a big U.S. presence. And I am curious if whether the U.S. sort of lost that moment. It lost its opportunity to really put its stake in the ground in some of these nations in a way that China made no bones about doing itself.
So a couple of points. Soft power is extremely important, and that is related to the principle. I mentioned 4 points: power, prosperity, principle, and peace. So soft power comes to principle, and that is in those circumstances that we had, for example, USID or Peace Corps, which were contributing to American soft power. Now, shifting probably to the question of investment, one of the competitive advantages that China has is the agility, the speed for investment. They come with holistic solution, not just to say some of the contract, but also with the financing. And the U.S. seems to be further delay when it comes to those operations.
One thing that's interesting, particularly for the nations that are here in the United States this week for this summit, Gabon, Guinea-Bissau, Liberia, Mauritania, and Senegal, is that all of them have kind of made clear that they also have a lot of natural resources that the U.S., of course, would like to get its hands on. And I am curious as to whether there is the potential for a meaningful deal for some sort of resource transfer that would, I guess, enrich both sides of the equation.
I agree that, yes, it is extremely important to engage in mutually beneficial deals. Let me put those into context. The U.S. currently imports about 100% of 12 critical minerals, including manganese, and Gabon, which is invited, is one of the largest producers, along with South Africa, of manganese. They also import 50% or more of more than 29 critical minerals, including platinum, uranium, and where China in rare earth will import about, or will be selling about an important quantity to the U.S. So knowing that Africa represents over 30% of the world proven critical minerals, the partnership like the one that we are seeing the U.S. trying to develop is extremely important. But the novelty here, and what many of the African leaders asked, is really not just to extract and export raw material. It's also to contribute to transform locally to create a mutually beneficial economic outcome.
All right, Doctor, we have to leave it there. A great conversation. Dr. Landry Signe is a senior fellow at the Brookings Institution, and his latest book is out, Realizing Africa's Potential, A Journey to Prosperity. Meanwhile, back here in the United States, we did see a touch of prosperity when it came to equity markets, with the S&P 500 just squeaking out another record high. But the real star of the show, that remains the more of the cyclical space, the economically exposed sectors like travel, like airlines. Delta Airlines out with earnings this morning, and a very bullish call by the CEO there to reinstate the company's guidance for the year. You see the Dow Transports up 2.6% on the day, its biggest outperformance relative to the broader market in at least 2 months. This is The Close on Bloomberg. All right, it's time now for our top three, where we name drop the people driving some of the day's most talked about stories. And we start up with Catherine Meunier, who has owned the original Hermes Birkin bag for the past 25 years. Well, no more. It was sold at auction, that black leather handbag there, for a record $10 million US. The buyer, a private collector from Japan, who is yet to be named. Next up, Bad Bunny. The musician's 30-date concert run in Puerto Rico kicks off tomorrow, with a residency expected to pump $181 million into the local economy. A lot of folks looking at the Bad Bunny bump as reminiscent of some of the bumps that cities got when we saw those big tours a couple summers ago with Beyonce and Taylor Swift. And third on the list is John Martin, the former chairman and CEO of the Turner Media Companies, is taking on a new role. He's going to be the CEO, he is the CEO now, of the U.S.-based Professional Fighters League. The move comes as the PFL tries to take some market share from the still dominant rival, UFC. I'm pleased to say that John Martin joins us right now as the new CEO of the Professional Fighters League. John, welcome to the program here. With regards to your new role and the idea of where the PFL goes after this, I mean, I'm sort of struck by your pedigree, obviously being a longtime media executive, and what you sort of envision to sort of promote this league and, more importantly, to get it in front of a lot more eyeballs.
Well, that's why this is so exciting for me personally, because not only have I spent over the last 3 decades in media and entertainment and sports, I'm a huge MMA fan. I became a student of mixed martial arts in my mid-20s and competed in amateur tournaments until my early 40s. When I look at PFL, it's, as I said, second largest MMA organization in the world. And all aspects of MMA as an industry are underserved. The fans are underserved, the fighters are underserved, and the commercial and media partners are underserved. So my job here, my entire career, I've been a builder. I've built businesses. I've led big companies, and PFL has a global platform stood up now. We're all over the world with 30 events this year, but now's time to continue to grow the fan base and start to grow revenues at an accelerated pace.
Where do you see geographically that growth coming from? Is this going to be primarily in the U.S. or overseas? Where?
Well, the U.S. is the biggest market in the world. You absolutely cannot ignore that. But if you look at the 30 events that we're going to host this year, 20 are going to be outside the U.S. And if you look at where the fans are, there's roughly 700 million MMA fans. 85% of them don't reside in the U.S. So we will absolutely pay attention to the U.S., and we expect to put on wonderfully exciting fights there. But we're in the process of establishing international leagues all over the world. We have a league in Europe already, in the Middle East and Northern Africa. We're, as I said, in the continent of Africa beginning on July 19th. We've announced that we're going to stand up a league in Australia beginning in the winter of 2025. And we're looking at Asia, India, Latin America, among others. So we want to be everywhere. And the important thing about that is if you're at an event and you see a popular local fighter come into the arena, the energy is outstanding. So PFL's ability to discover, develop, and nurture and promote up-and-coming talent, to give people a proper stage and allow them to realize their dreams, I think is critically important as we think about bringing the brand to more awareness and more fans and growing the sport.
What are your ambitions with regards to broadcast rights? I mean, how do you want this to be consumed, or at least how do you want it to be consumed in a way that's going to be most profitable and beneficial to the league?
Well, PFL today can be viewed in about 190 countries. So we're fortunate enough that we have rights deals with 20 premium linear TV and streaming companies, and we're getting paid by all of them. But if you compare how we're getting paid versus how the industry leader is getting paid, we think there's a massive opportunity for PFL because there are plenty of commercial and media partners that would love to get into MMA, and they've been closed out and haven't been able to do business with the UFC. So we have a rights deal coming up in the United States we have 1 more year to go on our existing rights deal. ESPN is our partner, and we look forward to sitting down with them and beginning to have discussions. And I see, I think our ability to garner more and more revenues going forward is going to be critically important. And the last thing I would say is this business has 5 revenue streams. All 5 today are activated, and that's a real privilege to be in a business with that many revenue streams. So I'm going to be focused on driving all of them.
All right, John, we have to leave it there. Really appreciate you taking time for us. Apologies on that intro there. John Martin, the former CEO over at Time Warner Media, now taking over the helm of the Professional Fighters League. Stick with us. This is Bloomberg. On this day where we hit a record on the S&P 500, let's push ahead to the next 24 hours and what could potentially move the market. We start overseas in France, where we are expected to get inflation data. That comes out overnight U.S. time. But when we come back later in the day here on the U.S. side, there will be a big focus on the federal budget. The federal budget balance will be released at 2 p.m., normally a data point that a lot of folks don't pay attention to, but with the passage of that big, beautiful bill, a lot of people will be paying attention to it. We'll also be paying attention to Amazon, the final day of that Prime event. Sales have been down on a year-over-year basis. Big question about what comes next. And we'll keep an eye on President Trump, who is expected to visit Texas to survey firsthand the damage from those deadly floods.